How's it going? I'm in the money, and today we're going to talk about a cash secured put that is in the money and how to handle it. So a cash secured put that stabs you in the back, what do? You stab it back. I will always keep you guys posted through these videos on all my trades and stuff, but if you want to see it before these videos are posted, you can. You just follow me on Iris down below, at In The Money Adam, and you can see all my trades and stuff. And for TD Ameritrade users who do not have that beautiful, clean, crispy graph that Robinhood users have, Iris provides that for you. They run a calculation on your profit and losses and just smack it on a graph. So it's one of the coolest features they have. So I recommend you download it, link your brokerage, follow me. We can see each other's trades and stuff. Eventually we'll be able to compete and all sorts of cool stuff. So just do it. And as always, when you link your brokerage to any third-party application, be sure to enable two-factor authentication just for an extra layer of security. Just a good idea. Two-factor authentication for your brokerage, that is. For those of you who've been paying attention, you know that I sold a Bumble put with a 55 strike, and we've actually already rolled it once. If I open up the spreadsheet here that I use to keep track of the wheel strategy, you can see we sold to open a 55 strike put for 265, then we rolled it at some point, buying to close it, and selling to open a new one with a further expiration. And so far, we've collected $370 worth of credits. So right now, we have a 55 strike put open that expires on June 18th. Just slightly under a month. And if we go to Bumble, we can see that it's trading well below the strike of our put. So this line represents the strike of our put. It's all the way down here trading at $40.65. You know, in hindsight, I'd rather have purchased this put. I'd be making a good amount of money. But what you gonna do? You gotta just figure out how to handle the situation and move forward. So we can actually calculate what our unrealized profit and loss would be if we get assigned. Okay, we're gonna assume that the stock price stays at $40 and we'll say 68 cents. So let's calculate that really quick. So the strike of my put is 55. The current stock price is $40.68 roughly. So it's pretty deep in the money, right? And if it's deep in the money, at any point someone could exercise this option, particularly if liquidity gets kind of bad and it would cost more to get out of the trade than they'd give up through exercising. Remember, when you exercise, you give up extrinsic value. But if you had to give up more than extrinsic value to find someone in the large bid ask, you would just give up that extrinsic value. It'd be cheaper. And that'll happen. If the extrinsic value becomes smaller than the bid ask and someone wants to close their position, they will just exercise. So it's entirely possible at any point I could get assigned. My counterparty exercises, I have to buy 100 shares at the strike price. And it is more likely that this will happen the deeper in the money it is, and it's pretty deep in the money, and the closer to expiration it is. Because the deeper in the money it is, the less liquid the options are going to be, the more likely it is that the liquidity is going to be a bigger problem than just giving up extrinsic value. And the closer to expiration it is, the smaller extrinsic value is going to be, which means they're giving up less, and it's also more likely that liquidity is a bigger problem than just giving up extrinsic value to get out of the trade. Okay, so if I got assigned, I would buy 100 shares at 55, and since the current stock price is $40.68, we'd calculate our unrealized loss as if we were selling at $40.68. Just like if you bought a share of some company at $100 and it drops by $1 to 99, your unrealized loss is calculated as if you sold at $99, you'd have a $1 loss, correct? So in this case, we're doing the same thing. We're pretending we buy at 55 and we're pretending we sell at $40.68. So we have to take the difference of these two. $14.32. Okay, but this is for 100 shares. We calculated this for one share, but when we get assigned, we were forced to buy 100 shares at 55. So we multiply this by 100, right? Move the decimal place over twice. That'll leave us with a loss of $1,432 unrealized, right? Unrealized. We have not sold our stock position when we get assigned, so it's an unrealized loss. But we're not done yet because we also have to consider the credits we've collected so far. So let's go back to our spreadsheet. We've collected $370 of credits. So we're going to subtract 370, and that will leave us with $1,062, if I did that math right. This $1,000 loss right here, you know, it kind of sucks. It's better if it doesn't go so low and that your put isn't assigned when it's super, super deep in the money. But it's not that big of a deal. We're not so concerned about the unrealized loss when we get assigned because we're going to continue to sell options against this position, right? So we sell cash secured put, we roll and avoid assignment as long as possible, trying to keep our puts expiration within 30 to 45 days until expiration. If we collect 50% of our credit, then we roll it back out to 30 to 45 days of expiration. It's okay if that expiration doesn't stay there the entire time. You want to collect at least 50% of the overall credit. You want that option to decay in value by 50%, and then you can buy to close and roll and open a new one with 30 to 45 days until expiration. So we're selling cash secured puts, right? It's like getting credits all over the place, and then when we get assigned, no big deal. We don't care about the unrealized losses. We're gonna start selling covered calls, hopefully above our cost basis, so that if we get assigned or covered call, we're gonna sell above our cost basis, which basically means sell in a place where overall we're gonna end with a profit after selling cash secured put, getting assigned, selling covered calls, and getting assigned. So my point is, if we run the wheel long enough, we will always recoup these losses. If things drop really hard and if our cost basis is up here, right? Our cost basis for the shares is up here, which is the strike of your put option minus all the credits you've received. And the stock drops way down here. We have to sell covered calls way up here above our cost basis. And that's really, it could be potentially very far out of the money. And that means we're not gonna be collecting a lot of credits. Those covered calls we're gonna be selling are gonna be kind of cheap. So that just means it's gonna take longer for us to recoup these unrealized losses. Eventually, we want to collect enough credits that the total cost of the shares would be just completely free if we get assigned. We collect so many credits that would bring our cost basis all the way down to zero. So while this kind of sucks, and while it might make it difficult to sell expensive covered calls above our cost basis, it's okay. It's the nature of the beast. That's why we want to be happy owning the company that we sell a cash secured put on. It's because we don't want it to tank super hard because of this exact issue, because it starts becoming harder to collect enough credits to counteract this unrealized loss. Now, you can always sell covered calls below your cost basis, but there is a risk that maybe overnight it jumps 20% and it gets in the money, and then you suddenly get assigned and you are assigned below your cost basis, and all of a sudden you end the one cycle of the wheel strategy with an overall loss. However, if your cost basis is really far, out of the money relative to the current share price, you may have to start selling covered calls below your cost basis. But in general, even if you sell it out of the money, way out of the money, you're not collecting a lot of credits because it's way, your cost basis is way up here. That's not such a big deal, because if you think the company's going to recover, great, that unrealized loss will evaporate as the company bounces and maybe starts heading in the upwards direction. For that exact reason, I'm kind of a little bit remorseful that I chose Bumble, which is a company that it's a little bit more risky. I actually would have rather done AMD, so I'm probably going to start the wheel on AMD as well, but we're going to keep the wheel going with Bumble. So then you might be asking, well, if you don't want to get assigned here, if you don't want to eat this $1,000 loss, which is going to be unrealized, so we're not really eating it quite yet, but if you don't want to hold this unrealized loss of $1,000, why don't you just roll at them? Well, I could just roll, but the problem with that is if I go to my positions here, I right click on our short put and we create a rolling order. Right here, we could roll from our June expiration to a July expiration for a 35-cent credit, which would be okay because we're collecting more money, but we're keeping the strike the same. So our unrealized loss when assigned would be the same if the stock price stayed close to where it is right now. If we try to lower our strike, we're going to end up paying a debit for it, which we don't want to do. We don't really want to eat a debit just to avoid an unrealized loss. We want to keep credits coming in the door when we're running the wheel strategy. Okay, so we could push the expiration out further then to create more time value in this option that we're rolling to and maybe hopefully get a credit. Let's see about October. Nope, still a debit. How about January? Still a debit. How about April of 2022? There we go. We finally get a credit, but now we're rolling it way out, 9 months out. I don't want to do that for a 60-cent credit just to reduce the strike of my put by 5 points. Odds are I'd collect way, way more money just by accepting assignment when it comes and happens, assuming the stock price doesn't bounce really hard, and then starting to sell covered calls. I'd start collecting way more credits than I would by just reducing my strike and by collecting 60 cents. It would take forever to collect that 60-cent premium, and we'd only be reducing our strike by 5 points. So overall, we'd be improving our position by $560, right? If we reduce our strike 5 points and collect an extra 60 cents, in the case of assignment, if we do get assigned that position at a 50 strike, we would be buying at $5 cheaper for the stock price for those 100 shares. So that's $500 cheaper. And then we'd collect an extra $60 just by selling the covered calls. That's $560. I can collect $560 real easy selling covered calls on those 100 shares by just accepting assignment. So this is not the most cost-effective position here. It's possible to do and be okay with. It's fine, I guess. You're still making money, but it's just not a very good return. And I know I could get a better return selling covered calls by just accepting assignment. So the moral of the story is if you get to this position where your cash secured put has gone really, really against you, you want to make sure that you can roll not super far out, like a month out at worst. Generally speaking, I want to be able to roll out to 30 to 45 days until expiration. If I can't do that for a credit, then I'm just going to accept assignment. We are not so concerned about the unrealized loss of our stock position. We are concerned about collecting as many credits as possible. Those credits will counteract the unrealized loss we're holding over time as we continue to collect credits. And if the stock price goes up, which you should be doing this on a stock that you like, then it'll eat those unrealized losses anyway eventually, and you'll be collecting net gains on the stock as well as the credits from selling these cash secured puts and these covered calls. So if things get in the money, you want to roll quickly. The deeper in the money things get, the harder it is to roll. So once things start getting in the money, if there's 14 days till expiration and your your put gets in the money, roll it back out to 30 to 45 days to avoid assignment, because that's a perfect position to do so. You could easily roll it for a credit and perhaps even lower the strike and still put it right within that 30 to 45 days till expiration range where the exponential ramp increase in theta really starts benefiting you. But if things start getting in the money and you still have like 40 days till expiration, and rolling means you're gonna have to put it so it's like 2 or 3 months until expiration, that's not optimal for collecting credits. It starts slowing down how fast you collect the credits from the covered calls and cash secured puts you sell. So in that position, you just want to hold and wait and see if things bounce and push your put out of the money. But if it doesn't bounce and it starts getting very deep in the money very quickly, and there's, you're still sitting about 39, 40 days till expiration, you're just going to leave it. You're just going to accept assignment. So that's what I'm doing. I'm just waiting for assignment essentially. And then we'll just start selling covered calls. That's the point of the wheel. Everything that happens, selling cash secured puts, getting assigned that cash secured put, and selling covered calls, getting assigned that covered call. Those are all things that are going to happen. The important thing is to roll when it's optimal, which means when it starts to get in the money and you can roll it out to 30 to 45 days until expiration for a credit, and to sell above your cost basis when you start selling covered calls. Even if you're collecting small amounts of premium when you sell those covered calls way up above your cost basis, it still might be worth it because the stock price could start rising. And then you can start selling higher credits, and you're also recouping those unrealized losses because the stock price is rising. You can take a risk by selling a covered call that's a little below your cost basis, but just be prepared to roll, which means you might want to choose an expiration that's not 30 to 45 days out, maybe a bit closer. You can sell a covered call below your cost basis, but you have to be lightning fast when you roll it, and you want to roll it as soon as it starts getting close to being in the money. And just so we're all tracking, my profit loss so far in this account is minus $3,700. So we've been eating a little bit of losses because of all the concerns about inflation, all that jazz, but no big deal. Also, as much as I love M1 Finance, and I made a video about it, I'd really like M1 Finance, but I want you guys to be able to see everything I'm doing on Iris, like literally everything. So I'm transferring again. It never ends, dude. I constantly hop from brokerage to brokerage, but I'm transferring all my stocks into this account so you can literally see everything I'm doing. There's not one aspect of my investing that you can't see on Iris. And it's kind of a good thing anyway, because that means I'll be able to start running the wheel on more stocks, because if I have a bunch of marginable securities in this account, $130,000 worth, I'm going to have a bunch of margin available to use, and I can sell puts on those margin and start running the wheel on more stocks and not just Bumble. Particularly, I would like to do AMD. I love AMD, and I kind of wish I started with AMD, not even considering Snap or Bumble, really. I was too focused on a cheap stock price than a company I was interested in. Okay, so we can't roll for a credit to any date that's even kind of close, and we couldn't, definitely not if we lower the strike. So what do? We just sit on our hands and wait for assignment. That's all we do. We've collected $370 so far. Over time, we're going to collect tons and tons of credits until who gives a crap about any unrealized losses. We've collected so many credits, it doesn't even matter. Getting assigned is basically just free shares at that point because you made enough money to buy those shares at the strike price. Oh, I want to show you one thing really quick. I keep forgetting. If you guys want to buy these pins, pretty good. You can check out Pins by Charlie in the description below. There's also this guy, all right? And you also get a sticker with my face on it. Well, bam. Thanks for watching.